Hello. Let's work on the Jolie's company question. We have a couple of intangible assets, and we need to record transactions in regard to these assets for the year 2016. The first one, we had a patent that was purchased in the previous year. So in 2016, we do post the amortization. We do recognize the amortization of the patent. So the amortization expense for this year is going to be, since the useful life was 10 years and it was purchased for $500,000, we divide that by 10 years, so we have an amortization expense of $50,000, and we decrease the patent by $50,000. So a credit to the patent reduces it by $50,000. So we're simply allocating the patent to its useful life, which was established that it's 10 years. If the circumstances don't change, every year we're going to have this for the next remaining 8 years. So that's the yearly amortization. For the second one, our company purchased, this company purchased a franchise from Unol Company, and this franchise cost $240,000. So intangibles, we record them at cost. So we have a franchise for $240,000, and we assume we pay this out in cash. So cash $240,000. Additionally, we made revenues in regard to this franchise of $620,000. So we have cash $620,000, and that's our sales revenue, $620,000. Another item related to this franchise is that there is a requirement that we pay out 8% of the revenue to Unol. The 8% of revenues, we're going to have a franchise expense. So it's an expense related to this, to the franchise. And we assume we're paying it out in cash. So we're going to pay out 8% of the $620,000. So we're paying out 8% of 620. So we have $49,600. So we have $49,600. Let's note that we're not going to amortize this franchise because we are not, it was established that it has an indefinite life. So we do not amortize it. We're just going to review it for impairment as required. And if we establish at a certain time in future, in the coming years, that this needs, this is impaired, then we'll record an impairment. Other than that, it's established that it has an indefinite life. The next one, we have a couple of R&D costs. So we have R&D costs. So we're going to record an R&D expense. So that's our 3. We have R&D expense. And we assume we pay this in cash. So for the R&D expense, we have a total for the 3 of them. We have $80,000, we had the $40,000, and we had the $50,000. So together that comes to $170,000. And we assume we paid $170,000. For the fourth one, we trade name which had been purchased in 2012 for $80,000, and we suspect that so this substitute, a trade name for a substitute, that is causing problems. So this will is likely to cause issues with the value of the intangible asset. So this necessitates an impairment. And the company established that it is we're going to impair this because at the beginning it was for 80,000 and the fair value was estimated to be 0. Now that it's being linked to cancer, so we need to remove it. It does not have a value anymore. So loss on impairment is the entire 80,000. And we remove it from our books by doing a credit to the trade name. So it's management is charged that this is now worth 0. The last one, we have a company purchase and we have assets and we're given the book values and the fair values. Note that we do use fair values when we are computing goodwill. So we need to record goodwill for the last one. So among the assets that we acquired, we have cash for cash of 50,000. We also acquired inventory at a fair value of 160,000. We acquired property, plant, and equipment. Property, plant, and equipment for 900,000. We also have some liabilities. So 2 of them, we have accounts payable. And that has a value of 75,000. We have notes payable for 175,000. We also have, we're combining this with the payment itself for goodwill for the company. We purchased this company for a total of 950,000. So we have a cash outflow of 950,000. And with this, if we had the credit and subtract the debit side, we're going to compute to determine our goodwill amount. So goodwill comes to 90,000. Note that the goodwill can also be determined by doing the taking the difference between the cash paid for the company and the net assets. So if we do 950,000 subtract the net assets, which means the assets we have 50,000, we have 160,000, we have 900, 900, and if we subtract this, so all that's our net assets, we subtract 75,000 plus 175,000, this will still give us 90,000 for the goodwill. So this is the other way of looking at it. We take the cash value that we paid, subtract the net assets, which is what I have here. The entire amount there is our net assets. So assets minus liabilities, and we subtract that from the money that we paid for goodwill. That will give us 90,000. Just another note on goodwill is that sometimes, although it's rare, goodwill can be, sometimes the company might pay less than the fair value of the assets, net assets acquired. That would happen especially like during the financial crisis, or if a company is in distress and they decide to sell for a lower price. In that case, if that case happened, that would lead to a negative goodwill, which we do not record. So we usually do not record negative goodwill. What we do is we record a gain, but we do not carry it in our books. So we've completed the requirements for this problem. So just that was just a note on if you encounter a question somewhere that results in negative goodwill. We do not record negative goodwill. So that's it.